This video will be about life strategy funds on Vanguard. I will tell you about what a life strategy fund is, how to choose one, how to open a life strategy fund on Vanguard, and the life strategy fund that I chose for myself. So if that's something that interests you, then please keep watching. Hello guys, welcome back to my channel. My name is Anastasia. On this channel I talk about investing and especially investing for beginners. If you've been following my channel for some time, you remember that in all my videos about Vanguard, I've been always saying that I don't like that I depend so much on the economy of the United States, because the main fund that I invest my money in is S&P 500, which covers only the US. So I've been saying that for the next year, for the next financial year, my plan was to diversify my portfolio further and also to use my stocks and shares ISA allowance more than what I did last year. So I've been reading a lot about different funds on Vanguard and I was trying to choose the best one that would suit my own strategy. I came up with a conclusion and I would like to share my thoughts with you today, also the knowledge that I got, with the hope that it will save you some time and also hopefully money. Now, as you probably already guessed, I chose to invest into a life strategy fund. I will tell you about the life strategy fund that I chose for myself, but before we start, let's first try to understand what a life strategy fund is on the first place. If you think that investing through Vanguard is a passive way of investing, you are definitely right. But investing through a life strategy fund on Vanguard takes the passiveness to the all new level, because all you have to do is to choose one fund, and there is not such a big choice of them. And after you chose your life strategy fund, that's it. That's why another name of a life strategy fund on Vanguard is a one decision fund, because you take this decision only once. You choose the Vanguard fund that you want to invest in, I mean the life strategy fund, and that's it. After that, everything is done for you by Vanguard. So Vanguard chooses the underlying assets that you are going to invest your money in. Vanguard is thinking about the diversification of your fund, and Vanguard also rebalances your portfolio constantly. If you want to know why rebalancing your portfolio is so important, you can watch another video on my channel that I'm gonna attach here. But basically, I say in that video that it is very important to rebalance your portfolio in order to minimize risks and to maximize your returns. And I also say in that video that usually it's enough to do it once every 6 months or once every year. But with Vanguard, they do it every single day for you. So imagine how much time you save just by choosing a life strategy fund over just a normal fund on Vanguard or somewhere else. Each life strategy fund consists of two groups of assets. That's equity, meaning shares and stocks and shares, the parts of different companies that you invest in, and bonds. Bonds are a completely different group of assets, and these are loans that you give to companies, governments, different organizations, and these two groups of assets are completely not correlated between each other. There is no connection between them. That means that usually, historically, when one group is up, the second group is down. And that helps you to keep a perfect balance in your portfolio between the two, keeping the risk as low as possible and at the same time getting okay returns. I say okay returns because there are other funds that can show you higher returns in the past, but for the risk to return ratio, there are almost no competitors to life strategy funds. And the very good thing about these funds as well is that the risk score always stays the same, because Vanguard, as I've already said, rebalances this portfolio for you each time one group of the assets underperforms or overperforms the other. So within each life strategy fund, there are two groups of assets, being equity and bonds, and also within each group of these assets there are many different funds chosen for you by Vanguard, so that you don't have to break your own brain trying to choose the best fund or several funds out of all the big choice that Vanguard offers to its clients. My decision to start investing into a life strategy fund in this financial year was based on these advantages that I've just mentioned to you. Now let's discuss how we should choose a life strategy fund that suits our strategy and our goals. There is a choice of life strategy funds on Vanguard, and each fund consists of different percentages of equity and bonds. Depending on this percentage, the risk score of each fund is different. And usually, because equity is considered to be higher risk assets than bonds, the higher the percentage of equity is in your fund, the higher the risk score of the total fund is. The highest risk is in the fund that consists of 100% equity. There are no bonds at all. You get very good diversification within that fund, so you are investing into many different companies all over the globe, so you don't depend on the economical situation of one geographical location or one country in particular, but you don't have the second asset, you don't have bonds, so you have nothing to counterweight the potential losses you might experience in case of the global economical crisis. Warren Buffett, the most famous and the greatest investor of all times, is a big fan of 100% equity life strategy fund on Vanguard. So it's not that bad, but it's about how big a risk you can tolerate yourself. The historical graphs show that stocks and shares always tend to recover after any crisis. But the question is, and the question that has no answer, no one will ever be able to give you this answer, is how quickly the price of these shares will recover to the pre-crisis level. So an investor who chooses this fund has to be ready to take the risk and has to be prepared to see the losses, to see that he's losing some money in his fund at any point. And there are several rules and theories that might help you to choose a life strategy fund for you, but none of them are strict, and you have to use your own logic, common sense, because nobody knows yourself better than you do, and also your individual financial situation, the goals that you are investing for. So I'm going to mention these rules and theories, but don't follow them blindly, please. So the first rule tells us that the percentage of bonds in our fund has to be correlated to our age. For example, if we invest into a life strategy fund for the first time when we are 20 years old, there should be 20% of bonds in our fund and 80% of stocks and shares. If we start investing at 50, it should be about 50-50. And if we start investing at 80, at 80, of course, it's a little bit too late. Although no, it's never late to start, and it's always better later than never. So if you start investing at 80, then there should be 80% of bonds in your life strategy fund. And the second rule suggests that we should choose our life strategy fund depending on the goals and the time frames within which we want to achieve these goals. For example, if we invest for some short-term goals, 1 to 5 years, we have to choose a low-risk fund with 80% of bonds in it, or as high a percentage of bonds as possible. If we invest for some median goals, 5 to 10 years, then 60% equity, 50% equity, somewhere around that would be okay. And if we want to invest for long-term goals, for example, our retirement or any goals that allow us not to touch this money for at least 10 years, then the higher percentage of equity in our fund, the better. So 80 or higher. The main idea behind these rules is that the higher the percentage of equity is in your fund, the higher the risk is that you will see big losses, because during economical problems or recessions, these funds tend to experience some losses, even up to 40%, judging by the historical graphs. So imagine if you invest into a high-risk fund for a short-term goal, you see the drop right before you have to use this money, and you don't give this fund the time and the opportunity to recover. You start panicking and you try to withdraw this money, obviously taking all the losses upon yourself. The same goes for the rule that suggests that you have to invest a life strategy fund according to your age. If you start investing at the age of 70 or 80, you might need to use this money in the next 5 to 10 years, and if the recession happens right before that, then you will end up just losing money without giving it any opportunity to recover in the future. If you are 20, on the other hand, you have the whole 40 years before the time you retire, and this long period of time of 40 years gives all the chances for your fund to recover. But of course, as your life goes, you have to rebalance your portfolio all the time. So if you start investing at 20, you can afford to invest into 80% equity fund. But the older you get when you are around 40 or 50 years old, you have to look at it again and probably transfer all of your money into a safer option, into a safer life strategy fund. This is how it should work in theory anyway. If you are not sure about the risk score of a life strategy fund that you want to choose, you have to check this information on any investing platform. For example, this document on Vanguard is called Key Investors Information. You will see it next to absolutely each fund that Vanguard has to offer. But generally speaking, to give you a general idea, bonds usually have a risk score of 3 to 4 out of 7 on Vanguard, and equity funds have a general risk score of 5 and above, 5 or 6 out of 7. And the interesting thing is that only 30% of people are prepared to take a risk score of 5 and above. So think about if you belong to those 30% of all the investors who invest their money on Vanguard. Because choosing the fund that has the right risk score for you, for your situation, is one of the most important things that you have to decide before you choose your fund. There are some consequences to choosing the fund with the wrong risk score. Basically, there are two possible consequences if you chose the fund with the wrong risk score. If you chose the fund with the higher risk score than what you can tolerate, then you will most probably panic when you see the value of your investment going down. That's pretty logical. If you invested a fund that has 100% equity, but you need this money in the short term, as soon as you see the value of your money going down, you will most likely start panicking and try to withdraw this money. The second possible situation is if you invest into a life strategy fund with the lower risk score than what you could have taken. In that case, you might lose on some of the potential profits that you could have in the future. There is an interesting graph that I offer you to look at with me. It's called the performance of Vanguard life strategy funds over the last 5 years. And as you can see, starting with the same sum of investment at the very beginning, the Vanguard life strategy fund with 100% equity at the end wins and brings you the highest returns, whilst the life strategy fund with only 20% equity, where 80% of your money is invested into bonds, brings you the lowest returns at the very end. But at the same time, look at how much smoother the graph, this red line of a 20% life strategy fund is. And also look at the drop that a 100% equity fund had, and this drop has happened at the beginning of the pandemic last year in March. So if you think that you could see your money disappearing over several days, 40% of your money disappearing into nowhere without you knowing whether it's going to rebound or not, or when it is going to rebound. So if it's something that you are prepared for, then there is no problem. Well, it sounds pretty much straightforward, and it even sounds a little bit too good to be true. So where is the catch? I haven't found any catch for myself except of some fees that are included when you invest into a life strategy fund on Vanguard. And even though at the beginning these fees seem very small, over the years they are going to accumulate and get into quite a big sum. So for my personal financial situation and my investment strategy, I chose to invest into 80% equity life strategy fund this year. I'm going to set up a direct debit, so I'm not going to even look at what's going on there. I will only show you the updates from my portfolio, seeing the results that I achieved and the returns, hopefully profit that I will get in the future. That will come on top of everything else that I'm already buying on Vanguard. I made another video about how to open a Vanguard Stocks and Shares ISA account and how to buy funds there. So if you want to see this video, please click this link over here, because you will get a full explanation of what you should do and what Stocks and Shares ISA on Vanguard is. That's it, guys, for today for this video. I hope you found it useful. If you did, please click the like button below this video. Also consider subscribing to my channel so that you don't miss the future videos that I'm going to record. Thank you very much for your attention today, and bye bye.